Hey, Anthony here with Deliver Capital. Today's tips and tricks. We're going to be talking about equipment loans for startups. So what exactly is an equipment loan, right? It's really you going out and getting a piece of asset and qualifying for a loan against it. So very similar to you going to the car dealership, wanting to purchase a piece of vehicle. And once the dealership sells you that vehicle, they have a loan or a lender that will lend against that asset. It's a lot easier to qualify for these type of loans because you know what happens if you don't pay for that vehicle, they repossess it and take it. Very similar in this concept here. There's 1,000 different types of equipments that exist, but just to name a few, you know, there's heavy machinery, there's vehicles, gym equipment, medical equipment, printers, computers, technology, there's software, restaurant appliances if you're opening up a restaurant. You know, so depending on the strength of the collateral, will be easier for qualifications depending on the bank that you use. Now here you also have the option to either purchase it outright, or they do something called a lease to own, where you lease the asset. At the very end, you have the option to buy it for $1. You know, it depends on, of course, your tax benefits for incorporating this strategy. There is up to 100% financing available. Now, let's say for startups, it could be a little bit easier for you to put down 10%, 30%, up to 10 to 30%. Maybe you get a better interest rate, but you know there are lenders out there that can give you up to 100%. And business credit does help in this equation, right? So if you are able to establish some business credit before you move in, a lot of banks look at Dun & Bradstreet. One in particular for equipment is called PayNet. And if you can establish these two before going in, it's in your best benefit. If not, then you have to move in as is. Some typical rate and terms to expect. Approvals range from $10,000 all the way to $250,000. Of course, if you need more, you need a stronger profile to qualify that. But these are the average that we see, you know, typically when you're starting out. Interest rates from 8% all the way to 30%. Yes, I understand 30% is a lot, but as a startup, you are considered risky. And if you don't have a strong profile, then they can actually give you that 20 to 30% range. I've seen it before, but you know, it's in your best benefit to increase your credit score, bring you stronger financials, as we talked about in this section right here. You know, so the liquidity and the strong financials can equal a lower interest rate. Jumping back over here, your rate and terms, your terms can be anywhere from 1 to 7 years. Very, very common for 7-year terms. You know, 5 to 7 is really what I see, you know, on average. On the startup phase, I think they give more in the 5 years. So, you know, again, we do have lenders that are able to give, you know, these lower interest rates in the high single digits, lower teens. If you have 740, 760 and above, and you can demonstrate that. But, you know, the minimum that we require is around 640. Of course, we get some compensating factors. We have seen them get approved for lower, but I do expect those higher interest rates from that. You know, so with the startups, because you don't really have any business establishments, they're going to look a little more heavy into your personal side here, right? So going back to the financials, liquidity, credit score, you know, if you have this intact, this will be in your benefit there. And some of these lenders will ask for some experience, right? You need to demonstrate some experience. You know, if you are trying to, let's just say, become a manufacturer and you need equipment for building your business, but then you came from, you know, the gym and personal fitness department, right? That industry. So those two don't really match. It's highly likely that you might fail because you don't have the experience to withhold that type of industry. So, you know, if you have, well, maybe I had a different example there, but oh well, you have a new one. So there are programs for either no doc and light doc applications. Typically, if you're in business for more than 6 months, we like to see that 2-year mark, but they do exist out there. But you have to be a little more in that under the year range to qualify for some of these. And you know, the benefit with equipment, because it's collateralized, it's not as risky to lend to you. You can get approved in as fast as, you know, just a few days. Some of the requirements you need for starting out, you know, if you're actually employed, your W-2s, your last year's tax returns, 30 days worth of tax pay stubs. You're self-employed, typically last 2 years. Definitely great to show some liquid assets, you know, 1 to 3 months of your statements for any of these type of accounts that you can provide. and a personal financial statement, right? Some of your assets and liabilities and what you currently have to list and show. Getting deeper to your liquidity requirements, and if you have money in your checking and savings, 401k, stocks and bonds, money market, mutual funds, CDs, et cetera, it's always best to show the lender, right? So if you have that, $100,000, you might be able to get a higher approval and even lower interest rates if you have that can prove. And again, I always teach the rule of thumb for reserves. Have about 6 months in reserves in your account just in case things hit the fan. That can help with your qualifications. Alrighty, guys. Well, this is Anthony with Deliver Capital. If you give us a call, 888-311-9894. If you have any questions or concerns, well, I don't know why you have concerns, because they're only questions, right? Happy thoughts, happy grades. Thank you.